Hi, I'm Ha.
I'm Tish.
And I'm Yen.
This is the market view presentation from Group 10. So, to do the market view, we focus on one currency pair, which is AUD and USD. To make prediction about the future change between these currencies, we'll go about comparisons between Australia and the US in terms of the inflation rate, growth rate, and interest rate. For each indicator, we firstly review some related theories that provide the influences on a currency's exchange rate. Then we state the actual data comparisons to predict the future against each other.
So firstly, we're going to analyze the growth rate. Real economic growth rate is a rate at which a nation's gross domestic product, or GDP, grows from one year to another. GDP is calculated by the following equation. In theory, if a country's growth rate were to increase, for example in Australia, then we can expect that its components would have also increased. This fact leads to an increase in demand for AUD and shifts the demand curve to the right, rising the equilibrium exchange rate. All in all, there is a positive relationship between a country's growth rate and the value of its currency. Now let's look further into AUD against USD with much deeper analysis. Figure 1 from Statista 2018 presents Australia's growth rate from 2012 to expectations until 2022. Looking at the chart, we can see that before 2018, Australian growth rate fluctuates with an overall trend to decrease. The rate surges significantly and suddenly in 2018 to 2.92%, then starts to gradually decrease again in the following years. This is explained according to Maddock and McLean, where they suspect that as the economy within Australia shifts more towards service, the measured productivity growth in relation to Australia's economic growth will decline. Figure 2 from Statista 2018 makes predictions of the US's growth rate from 2010 until 2020. The chart reveals that since 2016, the country's growth rate keeps shrinking quite noticeably until 2020 to only 1.68%. This is theoretically due to the United States government and their lack of funding towards the nation's employment and service industry that is causing this decline in GDP growth. Comparing the two charts, we can see that in both countries, growth rates are supposed to lower in the few years to come. However, the growth rate of Australia is always higher than that of the US in number. Additionally, the pace at which the Australian rate decreases is also less remarkable than the American rate. Referring to another source, which is the Australia Reserve Bank's graph of exchange rates between AUD and USD, we see that there is a trend for the AUD to appreciate against the USD over some time in history. Therefore, based on some research, we might come to the conclusion that both countries can seem to expect a decline or threaten economic growth. However, in this instance, America's unemployment affects growth more than Australia's obsession over service. Hence why AUD has climbed in its value against USD and might even totally appreciate it in years to come. But we must look towards the other indicators to see if this could actually be the case.
For the second indicator, which is the inflation rate, according to Chin Eden, inflation rate is among the most influential forces on exchange rate. Viney established a negative relationship between a country's inflation and exchange rate. In detail, an increase in a country's price of goods and services would likely lead to its currency's depreciation. There are two underlying reasons for this. Firstly, as domestic prices increase, the demand for goods and services, as well as for the country's currencies, would decrease. This shifts the demand curve to the left and lowers the equilibrium exchange rate. Secondly, an increase in domestic prices also lures the country into buying goods and services, as well as currencies from foreign countries. This shifts the supply curve of domestic currencies to the left and increases the equilibrium exchange rate. The following graph compares year-ended percentage change in the Consumer Price Index of Australia and United States in 2017. Data is derived from United States Department of Labor and Australian Bureau of Statistics. Looking at the graph, we can see that in both countries, inflation is quite stable with a trend to slightly decrease over time. Though differences are minor, Australia tends to have an all-time higher inflation rate than the US. Recently, both countries experienced an increase percent in December 2017, as Australia's percentage change is 1.9%, higher than that of the US at 1.8%. According to the theory stated earlier, we would expect the AUD to depreciate against USD. However, it should be noted that the difference of only 1% implies inflation rate in this situation is a weak indicator. Further data is needed for more careful consideration.
Moving on to interest rate. According to Vinny and Phillips, 2015, the rate of interest perhaps the most obvious influencer on the exchange rate of the currency. In detail, when a country interest rate goes up, its currency exchange rate is likely to go up as well. Taking AUD and USD as example, this can be explained in this way.
When Australian interest rates rise, given that those in the US remain, the US investors might like to place their excess cash in Australia for a higher rate of return.
This would increase the demand for AUD and shift the demand curve to the right. At the same time, Australian investors would not want to exchange their currency to US, which limit the supply of AUD and shift the supply curve to the left. All in all, the equilibrium price goes up. According to RBA 2018, the cash rate has decreased significantly from 7.5% to 1.5% in a period of 2008 and 2018. In the next 3 to 6 months, the interest rates would be expected to remain at 1.5% or lower due to the decrease in unemployment and low inflation rate. As the labor market has strengthened, the labor force is expected to solidly grow in the next period. Therefore, it might be an upward pressure on wage growth in the next 12 months, according to Guardian 2017. Moreover, according to Law, the inflation rate remained low at around 2% due to the low growth in labor costs and strong competition in retailing. Following the recent event, the US Federal Reserve decided to raise the US cash rate above Australian cash rate for the first time in 18 years at 1.5%, according to Chang 2018. It means the US Central Bank has intervened money market by changing short-term interest rate. The interest rate of the US is expected to increase for the next 3 to 6 months in order to respond to inflation. To sum up, the AU interest rate is lower than the US interest rate. As a result, the AU dollar might depreciate against the US dollar.
From the three indicators we have analyzed, growth rate, interest rate, and inflation rate, we can conclude that due to recent times, the AUD will in fact depreciate against USD currency value. Despite the growth rate pointing out an appreciation throughout history, recent interest rates and inflation rates indicate this will not be enough for AUD to appreciate over USD in the following years to come.
Thank you for listening, and with that comes the end of our market view presentation of the AUD against the USD.